Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, Thekouk, thekouk.com, and on X using the handle The Kouk. Stephen, good morning.
A very good morning to you, Sean, after an amazing week last week and with another amazing week about to hit us.
What a cracking week we had last week. We had inflation figures, we had the US Fed, we had retail trade, we had building approvals, but we also had home prices. Where do we start with all that? I suppose the big one, well, the big two that we really want to discuss mostly, CPI here and what the Fed said.
Yeah, CPI here was pretty much on expectations, but, and it's a really important but, the market was fearing that it would be higher, that it would be worse, that inflation would be even stickier than it currently is. So in a way, the fact that it wasn't any worse, and it was broadly as the RBA had been forecasting for the last couple of quarters, 3.8 for the headline figure, 3.9 for the trimmed mean measure in annual terms. And the market rallied, the bond market rallied like crazy. So we had yields dropping, 20, 25 basis points on the basis of that result. Then we had the Fed come out, and while they were cautious in their dovishness, Jerome Powell, the Fed chairperson, indicated quite clearly that there's probably going to be a rate cut on the agenda at their September meeting. We just need to see, the next round of inflation data, the next round of activity data to come out to sort of lock that in. But the market's got about a 100% chance that the Fed's going to be cutting 25 basis points in the middle of September.
Pretty incredible. And of course, that led to share market rallies both in the US and here in Australia.
Yep. Gold, record highs. The ASX are, well over 8,100 points. We finally got there. That 8,000 had been elusive for, frankly, years. It got to the high 7,000s down. We rocketed through that. And I think that's partly linked to a couple of things, that interest rate question. So the relief, I suppose, that the probability of a rate hike is now in Australia effectively zero for all intents and purposes. Mm-hmm. So that's encouraged investors to step into the share market, particularly banks. My goodness. The bank share prices, when I look at them and any sort of long time series, they're booming. Gosh, who'd have thought Australia's relatively conservative banks would be yielding and growing like that? But it's a wealth effect. And, we also had, just by the way, last week we had the CoreLogic house price data. House prices are a record high. So if you've got a bit of money in super and a bit of money in the stock market, if you own your own property, you've made an absolute mozza in the last little while with the rally in assets.
Now, Stephen, this is the big week coming up, though. This is what it's all about. Michelle Bullock and friends get to talk about interest rates. What are they going to do? What are they going to say? I think we know what they're going to do, but what do you think they're going to say?
Yeah, you're quite right. About a 0.0% probability of a rate move in either direction. And up until the inflation numbers last week, there was about a 20% chance of a hike. So that's now gone and it's basically nothing. And you're quite right. So the RBA's got a messaging story to get out there. And we don't know quite what it is because we haven't heard from Michelle Bullock for quite a few weeks. Andrew Houser, the Deputy Governor, gave a speech, but that was sort of 3 or 4 weeks ago before all this really important news has come out. So my hunch, it is only a hunch, is that they will probably endorse the market and say, look, we probably don't have to hike interest rates because we know that growth is weak. And again, last week we had the very soggy retail sales numbers for the June quarter. So June quarter GDP, when we get that in about a month's time, will be pretty weak. We know that. We know the unemployment rate is increasing. We know, as we were just saying, the Fed's probably going to be cutting rates, joining a whole bunch of other central banks who are cutting rates. So the message from the RBA and from Michelle Bullock will be, look, we are happy that inflation was no worse than expected. We are acknowledging that economic growth is slowing. We are looking at global economic events and seeing soft growth, a dip in inflation, the easing bias of all these central banks around the world. And while we're not ready to cut, we've got a slightly dovish bias towards cutting interest rates, but not yet.
Mm-hmm. Do you think she'll be relieved? Or those CPI figures last week, do you think the Reserve Bank will be relieved?
The short answer is yes. I think They didn't want to hike rates. They made that very clear that they didn't want to hike rates because they could see the activity indicators being weak and a high inflation result. Had we had an extra, 0.2 or 0.3 on those CPI numbers, would have created a real dilemma for them. It would have been a very awkward message for them to say, well, we're not hiking interest rates, even though headline inflation's at 4 point something, trimmed means at 4 point something. The fact that it's just got that nose below 4% is a sign that they can now craft the messaging and breathe a sigh of relief, announce no change, give the press conference, which Michelle Bullock's done brilliantly since she's introduced those in the last 6 months or so. They put out their quarterly statement of monetary policy. So as you said, it's not what they do, it's what they say and what they write. So a lot of us economists will be poring over the 60 or 70 pages of the quarterly statement, looking at their forecasts and watching what have they revised. Are they revising unemployment up a bit? Are they revising inflation down a bit? Because that will be the true signal of their intentions.
Yeah, just finally, the Reserve Bank has been criticised for its forecasting over recent years, heavily criticised, though at least at the moment when it comes to inflation, it seems to be pretty much on track or at least in line with what the Reserve Bank thought.
Oh, indeed, and they deserve a tick. So for the last, I'd put it roughly 12 months. I'd have to check their statement on monetary policy from August last year, so a year ago. But I think they've pretty much got that unemployment drifting up to 4%, 4 and a little bit percent. It's currently 4.1%, so tick. They've got inflation falling a little bit below 4%, tick. GDP, we'll wait and see what the June quarter GDP numbers are. They're probably a little optimistic, but in broad terms, when your forecasts are only a couple of tenths out, that's a mighty accurate forecast because there's revisions, there's shocks, there's sort of global events and other things that can impact on your GDP forecast. So, having had a troublesome, problematic couple of years, and that was, remember, during and the aftermath of the pandemic. So forecasting in that environment was impossible to do well. Now that we've returned to the post-pandemic economics, if that's the right description, they're getting it pretty right. So we'll be paying, as I said, a lot of attention to those forecasts and benchmarking them against what the market sector's thinking about inflation, unemployment, and interest rate settings.
Stephen, enjoy your week.
Will do, Sean. Thank you.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on X using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.